Welcome to the pre-approval podcast, Sam. How are you?
I'm doing great, Adam. Thanks for having me.
You're welcome. So today you had announced, or as we were going back and forth beforehand, a couple of things of not just telling people no, but giving them a plan for success. And so before we go even into your background, I thought that was really unique and something that we haven't talked about yet. Do you want to explain that process a little bit, Sam?
Sure. It is part of our MO, if you will, comes from our company's model, and also just our team has embraced this. When a customer applies with us, we often hear from them that their previous experiences with other banks might be, well, I tried to get a loan with those guys and they said, after my credit was better to come back. And that's the only information they got. It's the only feedback they got. And of course, we know that credit is extremely complex and doesn't always make sense. And all the things you think you should do might not actually make a difference or move the needle. And so we've gotten into, when a customer applies or wants to see if they can get a home loan, the answer isn't just, no, sorry, try again later. It's, okay, here's what we got. This is why it's not working at the moment. This is how you can affect that. This is the timeline that you would or could see if you follow these steps in this order. It could be as fast as this or as long as that, depending on you. And oftentimes that does come down to credit. That's a big one. Of course, sometimes it's, hey, as soon as you save a down payment, then you can get a home loan in some programs. But oftentimes it's credit score, and they don't know why the credit is the way it is. We've tried to fix it for a year. We've been trying for 2 years. Nobody will tell us anything, that sort of stuff. So
That is awesome. So from what I have heard, previously, there can be these different buckets where people will normally go to someone that they're familiar with, which is a traditional bank. And then there's kind of this non-QM world. And then there's maybe this private side or people doing lease options or rent to own. And so you actually have experience doing quite a few different things. Do you want to give the audience a background on not only you, Sam, but maybe the company that you represent and all the different ways that you're potentially helping some homeowners?
sure. First of all, I work for a company called Flat Branch Home Loans. It's a Missouri-based company. We're licensed in 20 or 30 states. I personally hold licenses in 12 states, I believe. So from that point of view, I'm very versed in traditional Fannie Mae, Freddie Mac, conventional FHA, USDA, VA loans, down payment assistance programs through various states. We do all of those things. We do a lot of them. Both my wife and I are loan officers. We each have a team underneath of us separately. So she has her business, I have my business, but between the two of us, we do a lot of loans.
And when you say a lot, you don't mean like 10.
No.
You mean how many?
Yeah. We just finished calculating all the years, numbers, and things like this. And between the two of us, we did 1,000 loans, including our support staff helping us and things like this. But she did 600 and I did 400. She's a little cooler than I am. A lot of loans. And to put that in perspective, I suppose, is the average loan officer as of 2019's numbers will close 5 to 8 loans a month. So roughly 60 to 100 loans in a year. A very seasoned career loan officer would have a very decent business closing 100 loans a year, 100 loans a year. So with that said, yes, we work a lot and then some more, and then sometimes we go home and work some more. But ultimately, yes, we do a lot of loans. We touch a lot of loan types. We've seen a lot of scenarios, and we've helped a lot of borrowers overcome some of those things. And of course, it's great to have a borrower that has ideal circumstances. Those are easy. Anyone can do those. What we have found that when we are in the marketplace and we have competitors in our market, you get a couple of different, as you say, buckets. But when it comes to lenders, you get different buckets too. You have the banks that are fairly picky. They have higher restrictions. They're more conservative. Or maybe their loan officers are just salary employees and they're not really driven to try extra, if you will. We have lots of competitions that don't necessarily know the rules, and it's easy to be in that bucket because there's so much to know that we do get loans from time to time where another loan officer just didn't know they could do that, and so they had to turn that client away. And then, of course, the third bucket is the commission sales. We are commission loan officers. So I only get paid if I find a way to get you a loan. So that drives us to be creative and to dig and to learn more and to be educated, because that does help us both. Separate from the Fannie Mae and the Freddie Mac and the conventional loans, then you get into in-house lending, portfolio lending, construction loans or commercial loans, investor loans. That would be local banks lending local bank money at whatever policy and procedure they prefer, because they don't sell that loan. They don't have to answer to outside investors like Fannie or Freddie. They pick their policies per bank. So
Do they still have their own rules and regulations for what they have to do if they're keeping it in-house and
yes.
then how do potentially overlays factor with that? Or is that just, well, if a bank is sitting on some money, they can do whatever they well please?
If a bank is sitting on some money, they can do whatever the bank, well please. There's still compliance regulations in how you treat people, then discrimination and things like this still come into play. But if a bank wants to lend money on a construction loan with only 10% down, while most banks are going to be at 15% or 20%, typically, that bank can do that if they want. Most of those banks take their cues on the majority of their policies from national lending guidelines, because those take into consideration risk statistics. But a bank can, per relationship with a borrower, say, you know what, I've known you since you were 5 years old. I believe you'll pay that loan back, even though your credit's a little bit rough. We'll make an exception because, hey, I'm the loan officer and I get to make that decision. And
Awesome.
Each bank is a little different, and they do have different policies regarding those standards and what those rules are. So overlays are in reference to a lender that does secondary market, like conventional loans. Conventional guidelines say that you can do this, this, and this. Let's say a 620 credit score is a conventional loan minimum, but there are plenty of lenders who say, we have an overlay that we won't do any loans until we get to 640. Even on a conventional loan that says you could do 620, that bank has increased their protocol or policies a little bit extra because they want to take a little less risk. So I hope that answers that question.
It does. And the fact that you take this approach of, hey, we would love to do as much volume, and it appears that you have a great customer service model, that you're doing this many loans and people referring them to you, and you're able to close this many, which means, you are kind of helping your clients get into homes. And I know you even, just said that, I love getting people into homes. And so in this kind of unique subset that we're in, for the stat was 1 in 10 people are denied a bank loan, whether that's nationally or locally. There was some, statistics on it that I had pulled. But for those people that 1 in 10, giving them that path, can you talk about, and I know it's tough because you can say, if their credit score is, 400, that's different than if somebody's sitting at a 610 and the path. Sure. But can you tell us a story of maybe somebody that fits maybe in the middle of a normal circumstance where you say, you know what, you're not there, but this is how we can get you there. Do you mind just sharing an example so someone might be able to relate?
Sure. So I have clients where husband and wife, very joint finances. So the assumption would be then that their finances are congruent and their credit scores would be reasonably congruent. That's not always the case. But in this case, the wife was surprised to find out that her credit score was roughly 100 points lower than his, and they have all of the same everything, and all their bills get paid. And if you looked at their finances outside of their credit score, you would think that they were rock stars. Their debt to income ratio was very conservative, all the good things. And they can afford the house they live in now. They can afford to buy the next house before they sell the current house, like all the good things. But once upon a time, she went to the doctor, and some hospitals or medical facilities are somewhat notorious for just sending the bill and sending it to the collection agency at the same time, assuming that it's going to be real hard for them to get paid. And so, they send the bill, and 10 days later, there's a mark on their credit. And so she was showing a medical collection of, $40. But because it's a medical collection, and these two are also you would say younger, okay, mid-20s. Their credit history is not extremely deep, but very solid for the couple of years that they've had credit. Something like that can be really detrimental to a credit score because the length of history isn't 20 years old or 30 years old. And her credit score was 640, his is 750, and they want to buy a house. With that being said, the credit score dictates the interest rate. And from their point of view, we make good money. There's no reason why we shouldn't be able to get the best interest rates, except medical collection. So because of that, we encourage them to either A, call the medical facility and ask to do a pay for deletion, which is to say that if they can argue with somebody on the phone and say, listen, if I pay this off right now, will you send me a letter that says I can have it removed from my credit report? And they do the work themselves. They call the hospital, they call the medical facility, and they try to argue that or negotiate that. If that doesn't work, we refer out to a couple of credit repair agencies. We are, quick disclaimer, we are not credit repair licensed, nor do we practice credit repair. We simply coach from a point of experience and say, it looks like if you do these things, it would impact your credit this way. Feel free to seek out a professional's help in that regard. Between either calling the hospital and doing that business or talking to a credit repair professional, she was able to have that credit repaired, and her credit score reacted 100 points the next credit report. This happens to folks who have 400 credit scores, 500 credit scores, 600 credit scores. Similar things like that can be the culprit to an oopsie accidental situation that if removed from the credit report, everything goes right back to the way it should have been or would have been had it never happened. And we find that most people will say, well, I paid that off, but it still shows that there was a collection on your credit. Just because you paid it off doesn't make it go away. You have to have it extracted or removed to make your credit go back the way it was. So this happens all the time. Not just medical collections, but you can argue a lot of times with those creditors. Sometimes you can get them to give you that letter that says you can have it removed. Sometimes you can't, but it's worth making those phone calls and maybe even calling 2 or 3 times to see if you can get a different person on the phone. We had one client who got on the phone with a collection agency, and those collection agencies are not allowed to hang up on their customers. So they basically have to wait until you acknowledge that they're getting off the phone. And so he just refused to get off the phone and talk to this guy about his kids and their lives and their sports and all the things for probably 45 minutes until the guy finally said, fine, I'll write you a letter. So sometimes a little bit of grit will get you a long way.
That's pretty creative. I've heard it's told to me 2 different ways that there's difference between credit repair and credit counseling. And so, we often, because we're not a, agent, we're not a, a loan officer ourselves, we'll always refer people to, locally here, it's called the Village Family Resource Center, which is just a nonprofit credit counselor, which is different than credit repair, who typically are taking in my experience, a fee to help you out of a situation. And what I've heard on the wall, though I've never done it, is that there can be some maybe poor credit repair advocates out there who say, yeah, give me $1,000 and I'll fix your credit. And all they do is say, hey, go, pay your bills. It sounds like you maybe have some reputable credit repair individuals that you work with that what they should or should not look out for. How did you get to that point? And what would you recommend?
We've worked with a handful, because again, we are not credit repair specialists, and there's things that we can, once again, we can look at credit and see all the things that's there, and oftentimes can give a quick piece of advice and say, the software we use simulates credit. So it means that if we're looking at your credit and I see a balance on a credit card that is maxed out, not over the max, but maxed out, I can run a simulator that if I paid that down to 50% usage, will it affect your credit? Oh, yep, it will. And how long will that take? Oh, looks like 30 days from now, your credit score would spike up 20 points. So maybe we pay this credit card down to 50% so that we can get that score to spike up. But once we get past those sort of low-hanging fruit or easy ones, we do refer out to those credit repair agencies, because the good ones can get a lot done in a much shorter time than a person by themselves can. And we often refer this when we talk to our customers and give them those referrals. We let them know, like, you can take some medicine and put yourself to bed if you have a headache, but there's just times when you need to see a doctor. So we refer to it like that. Those credit repair agencies do charge money. We are not affiliated with them, nor do we collect any kind of fee or commission or benefit from them, other than if our customers get a good deal, a good go, they come back to us with improved credit and we're able to close loans for them. Otherwise, there's no back and forth. So having gone through trying a number of different companies, we found one in particular that we really appreciate the way that they do their pricing. Most credit companies or credit repair companies, and I can talk about the counseling in just a second, most credit repair companies that we are familiar with charge a monthly fee of some number, be it $100 a month or $500 a month or whatever it is, and they then slowly but surely work on a couple of those issues on your credit at a time. And my perception of that is, if I get $100 a month from you for every month that you're doing credit repair with me, then I am not as incentivized to fix your credit in 3 months if I can wait 6 months to fix your credit or whatnot. Not to accuse any company of doing said things like that, but I can see easily enough where that motivation may be misplaced. The credit repair company that we most often refer to is a per item post completion charge. So they take a retainer based on the amount of credit that needs fixed, but then they will only charge that retainer when they complete something. So as an example, and I don't want to speak for somebody, but let's suppose they charge $1 per item per bureau. That's going to be an incorrect number, but I'm making a very random example. And we see that there's 10 things on your credit that need to be addressed, and there's 3 bureaus. So that is $30 worth of work to be done. So I need you to put some number, $30, into an escrow account. And as we get success on those items, we will then draw against that retainer. If we are unable to remove one of those items from one of those bureaus or 2 of those bureaus or something, we will give you that money back when we have determined that it can't be solved in that way. And almost everyone we send, then, if it takes 3 months or 6 months or 9 months or a year, sees success or progress in those areas, but they're not charged any different if it takes longer or shorter. In fact, those companies are motivated then to make their $30 in 90 days if they can, versus trying to make $30 in 100 or 200 days if possible. We like that model. We like referring that model because very upfront, the borrower is told exactly how much it would cost if they are 100% successful, and the client has the opportunity to say, yes, I'm in for that, or no, I don't wish to do that, and that's the end of it. But they don't press or push, and they don't beat those clients up if they don't want to proceed. That's why we refer, for the most part, to those types of companies. And Adam, honestly, I think it would be an excellent guest for you to put on your podcast. It would be somebody from one of those companies to visit with how they do what they do.
Yeah, I would appreciate the referral and see if we can't get them on the next podcast, Sam. That would be great. Fantastic.
Yeah, sure enough.
So you've done, just through this conversation, it's pretty noticeable that you know your stuff and that been helping a lot of people. You even mentioned one thing that I haven't heard, too many talk about, which was, you've even talked about this kind of this third bucket that we were talking about of helping people that get into lease options know how long it's going to take them to potentially qualify for a loan. What we've seen in the negative is someone will say, just Joe Schmo down the street says, yep, I have this home, I want to sell it on a lease option. You can get your credit score in a bank in 6 months, right? And then they take an option fee. They, think that the people trying to buy the home have all the best intentions of buying that home in 6 months, but sometimes credit just takes longer. And that is one way that we definitely, advocate against that. Give yourself, a minimum of 3 years if you're ever going to do this lease option, or make sure you're talking with Sam or someone on his team that says, hey, I can get you into this in 6 months or less, or 3 months, or however long that would be. Can you talk about your experience from that perspective?
Yeah, sure enough. So A number of real estate agents that we work with on a regular basis know that we can simulate credit and that we can project timelines like that. And so a couple of years ago, I had an agent come to me and said, one of my investor clients is willing to lease purchase option this house to one of my buyers, but they are really uneasy about the idea that they don't know how long it could take, because at the end of the day, this particular investor wants the house to get sold. That's not always the case. And so to what you said earlier, there's a dark side to the lease purchase option world that we can chat more about in a minute if you like. But so she came to me and said, do you think you could work with this client and tell us how long it would take for them to buy this house if they did the right things and did the, et cetera. So it's been a couple of years now, so I probably don't remember all the exact details, but I remember thinking that we came to the determination that on the fast end, we probably could get this pulled off in 6 or 8 months. So everyone was comfortable, both borrower and seller and agent was comfortable putting a year timeline on that particular scenario, with an option for an additional 6 months if it came necessary. And the borrowers understood that they had a certain amount of time and the steps it would take, and they were very comfortable that they could get those things done from their point of view, because oftentimes credit adjusting or repair or something comes to throwing money at it. You're going to pay something off, you're going to pay something down, you're going to spend money to get something removed. And so they were comfortable with the dollars it might take to get those things adjusted. And so we proceeded. They wrote up a lease purchase option, and off we went. Approximately 10 months later, agent called and said, hey, call the borrower and let's kick this back up. The seller is motivated to sell this house, and we'd like to see if we're ready to roll. And so, of course, we reconnected with the borrower, and we were just about there. We had maybe 1 or 2 tweaks left. And so around month number 13, they were able to close on that house. Congratulations. And they own that house, to my knowledge, today, and all's well. And that seller got to sell their home, etc. So that's a good success story. From there, it was a little bit later that I had the opportunity, via a connection I had made with a CPA and my interest in real estate investing, that I got a chance to go meet with a couple of fellows that own a large number of houses. They built a company around owning and renting out houses, and so I got to go talk to them, mostly out of my own interest because I was pursuing real estate investment. And so I picked their brain for a good hour or so, and that was a great conversation. At the very end, he was explaining to me how probably 30 or 40% of their clientele, and we are talking about like 500 houses, 30 or 40% of their houses were under lease purchase options. They had turned this into a science. And so I just briefly mentioned, well, if you ever want me to look at somebody's file to see what kind of timeline they could close on that lease purchase option, and this company had been doing this for years, he looked at me and said, so you're telling me you can look at credit and tell me how long it would take for somebody to buy a house? And I said, well, yes, under ideal circumstances, if they're willing to follow the steps, yes, we can project and get very close to that, yes. And so he said, stay right there. He walked in the other room, he brought me back a credit report and put it in front of me, which probably he shouldn't have done, but he put it in front of me. He said, how long will it take her to buy a house? And I said, well, I don't have my computer with me, but in this case, I was in luck because it was a very simple one. She simply just didn't have credit. And typically we need about 6 months to get a credit score. And so I just handed it back to him and said, if she applies for a credit building credit card, she should have a 700 score in about 6 months. He was like, this is amazing. So for the next 6 months, I went to that particular town. I'm in Missouri. And so this was about 45 minutes away. And I sat in their office every, let's call it Tuesday, for 6 months straight while we called through all of their clientele and worked with everybody in a lease purchase option, asking them if they wanted help with their purchase journey, because they had the option, they had the contract. Could we help them get there? And so we were able to take applications on a large number of those folks and give them those guidelines and those steps to success. And some do, some don't, etc. And we were able to help a good number of those folks on their way to purchasing those homes. And that investor to his credit, was extremely interested in the success of those people. He was not motivated by taking the option fee and not selling the house on purpose, which is that darker side of lease purchase options. There are investors who will take that option fee, crossing their fingers the house actually never sells. So I don't like that, and I've never invested that way myself.
Agreed. So we're of the same opinion, and I'm glad that you brought that up. Kind of on the dark side of it. When we maybe if we kept going down that route and we went two different ways, can you share on those success stories, maybe a little bit of example numbers? And when you say lease purchase option, sometimes I've heard it called a lease purchase or a lease option, meaning that, sometimes there's a lease with a purchase agreement, attached to it. Basically says, hey, you're renting this and you will buy it, or you forfeit, earnest money or option, however you look at it. Or it's truly like an option where it's an option agreement. In those, I imagine it's just kind of a semantics of what you call the agreement. But maybe in those success stories, can you share a little bit of, hey, someone was looking at $150,000 house and they, wanted to do it, and their mortgage and principal and interest and taxes would have been, $1,200. But since they couldn't quite do that, they, decided to get in this lease purchase option. And then down the road, they realized, okay, then when I want to execute this, I maybe have to come in with some closing costs or something like that. Do you want to just generally talk through maybe an example number so people can kind of plan
Sure.
out in their head of, whether that's right for them? And then maybe we'll segue into the wrong way or the dark side of what to avoid by looking at something like this.
Sure thing. So if we're unpacking this, there's a couple points I would definitely want to outline so that anybody's into this is going to be able to at least remember, hey, I remember somebody talked to about this, right? First things first, I live in a market where it can be actually cheaper to own than it is to buy, which would make you think, why doesn't everybody own a house and nobody rents? Unfortunately, the cost of living is very low here, but also the median income is also can be very low. And so many folks who live paycheck to paycheck or month to month have a hard time saving up a down payment and things like this. And there are programs for zero down and such, but obviously knowledge is power and ignorance is what it is. People don't know, so they don't proceed or progress. So the lease purchase option comes about, and the seller says, listen, you want to own a home, but you can't buy a house right now. You don't have the credit for it or what have you, or you just started as a self-employed borrower, you're building a business, you don't have the income history or the 2 years tax returns or whatever is required. So we've got this house, we can rent it to you, or we can lease purchase option it to you. And again, they had become very, very good at explaining and coaching the client into why they might want to do both or one or the other. And so they would say, like, let's call it, for very round math numbers, let's say $100,000. Okay, for $100,000, you too can buy this house. And so then the customer, they would say, okay, what could you put down to secure an option for this house, and we'll consider it. Basically, they make an offer. They let the customer make the offer. The buyer says, well, I'm getting my tax return back in a couple of weeks, and we should be getting this much for that much down. And if the money we put down goes toward the price of the home, and it would in this case, if it's executed, then we could probably bring in $4,000. Okay, an FHA down payment, which FHA typically is the most lenient loan type, is a 3.5% requirement. Therefore, $3,500 on $100,000. So the seller says, yeah, 4,000 works because at least that hits that minimum when the time does come. So they write down the option, and as you say, there's a couple different ways to say it: lease purchase option, lease with an option to buy, lease option for short. My understanding is they're all fairly the same. So the rental agreement comes first. The dangerous part about this for the buyer or the client, the renter, is that the lease or the rental agreement does have the power to evict regardless of the option to purchase. So if they don't make their rent payments, if they get behind, they can be evicted like a normal home for rent, and that negates the option and it negates a refund. So they can lose their money if they are not good renters, so to speak. So what we want to ascertain first is, are we going to have any issues paying our bills and taking care of the property? Because if you can tear up the property, you might get evicted. If you don't pay your bills or pay the rent, you might get evicted. So that's number one. Number two is, and this was news to this company, they were not lenders, they were investors, and they did not know, for FHA loans and other loan types that apply, you have to source the down payment. When you put money toward the purchase of a home, you have to source it. You have to have proof of where it came from, bank statements from that era. If it was 2 years ago, you've got to have banking from 2 years ago showing that that money was in your bank account, how it got there, where it come from. So we would have to go and try to track down bank statements from 2 years ago showing they got a tax return of $5,000 and then they wrote a check for $4,000. And if you couldn't, they couldn't use the $4,000 for the down payment. So this is the point number two I want to bring up. The seller could still reduce the price of the home down to $96,000. But because, for instance, FHA still requires 3.5% down, and they were not allowed to use that $4,000 to solve that 3.5%, now that buyer now has to come up with another, what would be just shy of $3,500, maybe $3,200, to prove a down payment on now a $96,000 purchase price. So now we have put down 2 down payments to solve this and get this house bought because we just didn't know to keep track of our bank statements back then. So to that end, that company would now say, hey, we have another client filling out an application for a lease purchase option. Would you call them and pull their credit so we know how long to set it for and make sure that we're collecting any documentation we need to now? And they say, okay, great, we'll call the customer. So we do. And that we now collect that banking information now. We get their pay stubs and stuff now from that era, so that a year, 2 years, or 2.5 years, 3 years from now, we had it already on file so that when they come back to us and say, okay, we're ready to buy the house, we don't have to go digging. So a quick bad story from that is I had a customer come to me that had been in a lease purchase option for 8 years. She put $10,000 down on the house 8 years ago. The sellers were not really in a hurry, never raised the rent, didn't really care, it was fine. And she'd been living there for 8 years, just paying the payment. Now the sellers are motivated to sell the house, and they gave her a certain amount of time to buy or vacate. And she had changed banks since then, could not produce bank statements. We could not prove a down payment, even though the price reflected the $10,000 drop, because she put the money down originally. She still had to come up with 3.5% down to buy the house. It was unfortunate. She had the money, she was able to pull that off, but it would have been cool if it had not had to go that way. So that's the second point, is documentation at the time of contract. And then the third thing is as you say, the darker side of, there are a number of investors who buy houses and don't have an issue issuing a lease purchase option to somebody who isn't really able to buy a house anytime soon. And the unfortunate part is that most of them still look at credit because they're looking at credit like they would for a rental agreement. They want to see if there's any evictions or something. And a bad case of that might be, somebody does a 1-year lease purchase option with $7,000 on the line, and the client had a bankruptcy 6 months ago. There's no eligibility for them to buy a home until a year and a half from this moment. So that 1-year lease purchase option has 0 chance of success without extension. And if that seller is of the mind to take advantage of that, whether they looked deeper or not, 12 months from now, they say, well, you can extend if you give me another $5,000, or unfortunately you didn't make it, so you no longer have the option to buy, plus I'm raising your rent $100 a month, sorry. And we do get clients that have come from those circumstances that said, well, we didn't get the house bought in time, so we're just going to move out of that house and try to buy a house. Can you help us? So that happens too. They put money down, they don't get that money back, and the investor, the seller of that home originally says, yeah, sure, I'll let them out of the house. I mean, it's just a lease now. They can just tell me they want to move out. And that's it. So he got $5,000 or $6,000 or $7,000 plus rent for 2 years or a year. And our buyer ended up with rent plus a large deposit out of pocket that they don't get to get back. So
yeah,
I feel like that covers most of that.
That certainly does. Sometimes it's been asked about how rent credits work. And I think what you just described, I'm assuming that there was no rent credits because it was strictly a lease and a purchase option, or are there rent credits, and how does a lender look at that?
Yeah, so important. Yes, this would be I guess another point that we should bring up. So the same company that I was dealing with and that I worked with before, they would say, hey, we'll take $100 of your rent every month at some number, say $800 a month in rent. We'll apply 10% of that, $80 a month towards the loan, the house. And so then we would get to the end of, say they've been in that house 2 years, 24 months times 80 is around close to $2,000, I guess, give or take on a calculator. But they would say, great, can we use the $2,000 toward the down payment? And the answer is no. Number one, there is a way to do that. It's tricky. It has to be basically forethought for you to actually pull it off. You have to determine that they are paying over market rent to use any overage towards the down payment, and it has to be very specifically written as deposit toward, right? Which can get tricky because that means that if they don't buy the house, you also have to have verbiage in there that says it's that rent credit is also forfeited if they don't purchase the home because it was allocated toward down payment.
And do some people try to use that towards closing costs as opposed to down payments?
Right. So if you can document that the seller, actually you don't have the document. So let's say the buyer buys a $100,000 house and the down payment on FHA loan is $3,500. That's 3.5%. And the seller simply says, listen, if you want to pay $900 a month instead of $800, we'll apply $100 a month towards your purchase, quote, towards your purchase. And so it comes time for that to be done. Let's say they put $3,500 down at the time of the contract for the option. That's a separate check and we can document it. They have their down payment now. They pay $900 a month for 24 months. That's $2,400. The seller simply would then rewrite the contract because it's been 24 months to say, we're selling this house to this person for $100,000. We agree to pay $2,400 in closing costs. That can be determined at the time of loan start. We can just simply write an amendment to the original contract that says seller agrees to pay $2,400 in closing costs. That part does not have to be contracted at the beginning. They simply just say, if you pay your lease is $900, that's your rent. If you in fact purchase this home, we'll apply $100 for every month that you've been in this home toward closing costs or towards your purchase. They can simply just make that amendment on the fly. So that doesn't have to be documentable because it comes from the seller's proceeds. The buyers then just have to pay any additional closing costs that's not covered by the $2,400. So they have the down payment, they have $2,400 credit on a $4,000, or excuse me, on a $100,000 house. Let's say closing costs and prepaids are roughly $4,000. That buyer now just needs $1,600 to close and own the home.
This is fascinating. So from my perspective, there's very few people that understand the ins and outs of all this world. And so, Sam, it's pretty cool to hear like you basically break this down pretty simply for someone that maybe got into something that they didn't quite understand at the beginning, and maybe some advice of potentially talking with someone like you, or at your company, being like, okay, I'm thinking about doing this. And even though, maybe the investor is potentially doing that on their behalf after the fact, having someone reach out and just like say, okay, do I want to just rent for another year and then try to buy a home? Or if I really want this one and I got to get into this house and we want to do something creative, okay, what kind of terms should I put in there and what should I look out for and what kind of documentation should I do? So that is really cool to see someone, be able to break that down. And I think is a fantastic resource for anyone. And we'll be linking, to your website, and then and maybe you want to just rattle off right now where I can read it off from what you said, all the different states that you are approved through. I have them here if you want me to rattle them off. Otherwise, if you know them.
No, go ahead. Go ahead.
So Sam, you're able to help everyone in Missouri, Arkansas, Oklahoma, Kansas, Tennessee, Texas, Florida, Georgia, Kentucky, Minnesota, California, and Washington. And we'll have some notes, but it's hickey@fbhl.com. Otherwise, the leveluplenders.com is a great way to get in touch with you guys, and I'll be in the show notes. One last thing, maybe before we before we let go, I've heard of a couple different things on land contracts or contract for deeds, and
Right.
how that can be a little bit different than the lease options, and why someone would like to do this. So we kind of have a pros and cons of the two. Do you work much with land contracts or contracts for sale?
So we do get some clients that had an unsuccessful contract for deed scenario. I, as an investor, I have not done any contract for deeds selling, and I'm not, didn't have any opportunities to do as much in-depth work with like that, like I did with that company with the lease purchase options. However, but the basic understanding of contract for deed is seller says, you're buying this house. It's not a lease, it's a purchase. You're paying me a payment. That payment is just a loan payment. Basically, the seller is carrying the note, and you are welcome to refinance that or get traditional lending and purchase the rest of it from me in a lump sum at any point. But if you don't ever get traditional financing, you'll simply just pay this payment until this number of years is up, and then the house is yours. I'll hand you the title of the house, so to speak. It's a little more, say, simple in that regard to understand. Like, I pay you payments and eventually it's mine. Kind of like buying a car. I own it once I paid the last payment. But essentially, seems like less moving parts in most cases. But like anything, the correct way to do that is to typically get a title company involved and have a true title put into the buyer's name, and then the seller has lien on the property and can still foreclose much like a bank would. So that's something to keep in mind. I do want to add one more thing. Whether it be contract for deed, lease purchase option, or any other type of what we call creative or alternate financing, as a home investor, I buy houses, fix them up. I've sold some, I've kept some. Oftentimes when I list a house, we'll get messages through Facebook Messenger or emails or whatever and say, hey, would you consider a lease purchase option? And in almost every case, they have Googled creative financing or alternate ways to buy a house. They know what the term is. They kind of understand how it works. And then they say, great, would you be willing to do a lease purchase option? I could put X numbers of dollars down and we'd want to pay this much in payment. And that's about the extent of the knowledge there. And so, it's kind of like, well, I'm really hungry. I don't know what to eat. So I'm just going to buy everything at the store. Just be careful. Be careful to do the extra reading, visit more than one website, read up as much as you can, because what they know is they want to buy a house and for some reason they cannot, or they don't think they can because one person told them no. And separately, they've figured out that if someone will let them do a lease purchase option, it's the same thing as owning a home or creative way to buy a home. It is not the same thing as owning a home. They could be taken to court and kicked out just like any other renter. And so to be cautious, to take care in how they get into those contracts. And it doesn't cost but $100 typically to have a lawyer review something like that, contract like that, and worth spending the $100 or $200 to have good advice given in that regard. So.
And yeah, like you said, a lot of people think that they own the home just like a bank, like they would, like they're on the title and that there's a mortgage, against it. Not the same on a lease purchase agreement. I mean, in fact, I don't know any option agreements that are recorded at the county, courthouse, whereas like a mortgage or a contract for deed would be recorded. So if somebody went to try to sell that home, you would actually see some sort of pull or lien against the property, which would potentially cloud the title, not be able to transfer it. Whereas this, lease purchase option, unless you really trust the person that you're doing this with, if they went to sell it out from someone else, okay, then you got to hire an attorney to try and enforce a purchase agreement or a purchase option that maybe, does or does not follow even local, city or state statutes. And then, you're then trying to fight that, as opposed to having, maybe the law on your side, or like you said, maybe just wait 6 months, right? Maybe just wait a year, or maybe just talk with the right person. And that's why we're really, passionate about this podcast, because I feel like it's always the people that I don't think I can get a bank loan, or I talk to someone and now I can't. And it almost feels like some tension where they don't want to get denied again. And so they're super apprehensive about contacting someone, which is
Sure.
why with these podcasts, we're really hoping to shed some light on some good individuals like yourself, Sam, that are like, hey, we've been through this. We understand it. If you want to, you guys are a great resource, for them to start off with. If they're looking to buy a home, if they're looking to do, maybe something like creative, but talking with you guys first because you've, had all that experience would be a great, point to go. There was a couple other things that you wanted to touch base on as well that I don't want to forget. So you were actually, getting into some investing yourself. Do you want to talk
Sure.
about that a little bit?
Yeah. So it's something I always had an interest in, and it was a long-standing negotiation with my wife, of course, who's very risk adverse and always, like anyone who's interested in this type of thing is going to have that same thought in their head, like, I don't want to be a landlord because what if they destroy the house and all the things. So I started doing a lot of education, self-education, and eventually I got permission to try my hand at some real estate investing. And so in our area, there's very cheap houses. You can buy some very cheap houses that need work and things. And so in about 2017, I bought a house and we fixed it up and sold it. And that went reasonably well. And so I did another one. In 2018, we did 2 or 3 more. In 2019, I bought my first buy and hold, which is simply bought a property and put renters in it. And now I just hold that house or duplex as a buy and hold situation. And since that January of 2019, I have sold some, but keep most now. And I have roughly 50 addresses or doors, if you will, with tenants. And some of those properties are under renovation, and most of the stuff that I buy is broken and needs fixed. I like the transformation. I like to revive an old property and give it some new life. We've recently purchased a couple of new construction houses that have been, the numbers work very well, and it's kind of a nice offset to just investing in the market, if you will. And so along the way, as a lender, my superpower was that I had a very extensive knowledge of lending. Most people trying to get into investing, this is the part where they really have the uphill battle is understanding lending. So I'm not much of a hammer swinger, but the guy who's really good at construction, it takes him a long time to figure out what I know about lending. And so I started putting classes together for newer investors. And I also teach a class to real estate agents on how to work with and grow their business by leveraging investors. We often saw a disconnect between real estate agents. You either have real estate agents who are very familiar with this or real estate agents who are not familiar at all. And so I would get phone calls from realtors that would say, hey, I know you buy houses. I have a house you might be interested in. I'd say, okay, why would I be interested in it? They say, well, it's really cheap and it's on the corner and it's blue and it's really cute. So for real estate investors, we want to know, well, how old is the roof and how old is the air conditioning and what is the square footage and what can I buy it for and what will it rent for, and all of those sorts of things. And so we found ourselves educating a number of realtors when they would call and ask if we wanted to buy their listing. And so we started putting class together. So that's been a lot of fun, and I'm hoping to do more of that. It has really become a passion of mine. I do love working and helping people get home loans, but I really do love reviving some of these old houses and giving good folks who aren't ready to buy a house a good place to live. We're really, really passionate about being the opposite of slumlords, taking very good care of both the client and the properties. And so it's been a good journey the last couple of years, and I'm expecting to do a lot more of it in the future. And so happy to talk about those things, to most or all as they are interested as we go along as well. And so because of that, I do a lot of in-house lending the loans that I get from my houses are often with those local banks and those portfolio lenders, because I can do the construction loans and the line of credits that you don't necessarily see as often in the loans that I do for other people. My company doesn't do the construction loan or the renovation loans in most cases. So I go outside of my company to do those things. And so I've learned that side of lending as well. And that's how it's, basically come to be more well-rounded in that regard. So
That's exciting. So truly a passion on the real estate side, all things lending, appreciating the properties, getting, kind of improving the community as you go along doing that. If someone wanted to get a hold of you, Sam, what is the best way to do that?
Yeah, so I think I try to answer my phone as much as possible, and that information is listed on the Flat Branch website. It's Flat Branch or www.fbhl.com. That's F as in flat, B as in branch, H as in home, L as in loans. And Flat Branch is a tributary of the Missouri River in Columbia, Missouri, which is where that comes from. And when they started the company, had no idea that nobody in Texas would know what Flat Branch is. But anyways, fbhl.com is our generic website. And then you can also do the fbhl.com/S for my first name and Hickey for my last name. And then, of course, we have a direct link at the www.leveluplenders.com. You can connect with us. You can jump right in with an application. We will see it immediately and start working on it, get back to you same day. Worst case scenarios next day. And ultimately, if you're interested in whether or not you can buy a home or what it would take for you to buy a home, love to help, offer information to all, both qualified and not qualified. Happy to visit with you about what's possible. So
wonderful. You've been extremely helpful and valuable. Anything else that we didn't cover here today, Sam, that you want to bring forth?
No, I don't think so, Adam. I think we touched a lot of things, and I think the probably the motto in the lease purchase options and the contracts for deed and all that sort of thing is, just don't take no for an answer until you know why. And so if you talk to a bank and they tell you no, ask questions. Well, how come? Well, why not? But what if this and what if that? Because so often we hear from a customer, well, I can't get a loan. Well, why not? Because my credit score isn't 650. Well, that's silly. We do credit down to 600, and some banks go even lower than that. So with that being said, don't give up after the first no. Oftentimes it's just a no at that bank for one reason or another. Somebody else might be happy to help you with that loan. So,
and for the audience members that are listening to this and want to figure out what those other options are, we did a couple of recent interviews on the non-QM space for like the self-employed or, the small business owners. If you're, trying to do bank statement loans or doing, past tax returns or even, no doc loans. So feel free to reference back to that. I'm sure Sam could talk circles around this, but we've already taken up enough of your time, Sam. You've provided a incredible amount of value. So if you're in any of those states, or even if you want to talk to Sam about lending and getting, creative on the investing side, would encourage you to reach out. And thanks again, Sam, for joining us today and some great content.
My pleasure, Adam. Have a great day.
All right. Thank you.